Equity markets rebounded in April, regaining all of the losses that occurred in March, reaching levels not seen since before the crisis. The catalyst moving equity markets higher in April was the first quarter earnings season, which to date has been much better than analysts had been expecting due to a robust growth in revenues. The materials and industrial sectors have been the key outperformers, although the technology and energy sectors have also performed well. Strong merger activity also boosted equities. European government bond indices made gains and curbed the losses that had been made during the first quarter, with core government bonds outperforming and peripheral government bonds continuing to make losses. The yield on the 10-year German government bond fell from a high of 3.47% during April to a low of 3.21% at the end of the month. However, the spread of the Greek, Irish and Portuguese 10-year bonds over the German benchmark reached an all-time high as markets began pricing in a restructuring of Greek debt sooner rather than later. The rating agencies have also remained active on the European peripheral countries as Moody's downgraded both Ireland and Portugal's debt. S&P's decision to put the US AAA rating on negative watch was announced amidst much controversy about the spiralling government deficit in the US, which the IMF have predicted will be the highest in the developing world this year. Obama has responded to these concerns and announced that he plans to cut the deficit by $4 trillion over the next 12 years by reducing spending on entitlements and increasing taxes for the rich. This is at odds with the stance taken by the Republicans, who plan to tackle the Medicare bill. Despite this political gridlock, the next deadline for policymakers in the US is to increase the debt ceiling, which the US is expected to reach by August. However, a more cohesive plan to reduce the deficit may also be necessary to avoid a downgrade by the rating agencies. Inflation in the Eurozone rose to 2.8% at the end of April, indicating that the ECB may continue to increase interest rates following the 0.25% hike in April. Inflation in emerging markets also forced central banks to tighten policy. Chinese inflation increased to 5.4% at the end of March, forcing policymakers to increase interest rates and raise the required reserve ratio. Commodity markets continued to make robust gains, boosted by precious metal and energy sectors. In contrast, the dollar weakened significantly against the euro and is now trading close to levels not seen since the summer of 2008. The interest rate increase by the ECB pushed the euro higher, while the US Federal Reserve continues to maintain its extremely loose monetary policy.